Hard money loans can single-handedly be the best loan program or the worst loan program for your real estate portfolio if you don't know how to use it correctly. So this is going to be a beginner's guide on the pros and cons of hard money loans. And towards the end of this video, I'm going to cover a really big mistake that I see on the back end of funding these deals that a lot of investors are making right now in this market, and some things that good investors and what they're doing to be profitable when they're buying real estate portfolios. Now, for hard money loans, they could be used in one of two ways. You can either use them for a fix and flip, which is what they're commonly used for, or you can use them to quickly buy a property, fix it up, and then refinance and hold it. So I'll cover both of those strategies. So if you're a beginner, if you're looking to do that and you want to learn a little bit more about your hard money loan options, this is the video for you. So I'm going to dive right in. So what is a hard money loan? Now, as someone that funds a lot of these weekly, monthly, quarterly, I can tell you that they are a quick loan for property investors. They are made for buying properties that need fast decisions and flexible terms. They're based on the property value, not necessarily your personal income. So the loan looks at what is the property worth and what is its potential, not your usual income checks like tax returns or W-2s sometimes. So they're used for quick flips, renovations, or urgent buys, right? People that need to move quickly. And so if you need to move fast, normal bank loans typically take longer. These deals close in 7 to 10 days. Like hard money loans move very, very quickly. So the loan basics of how they work, and I'm going to talk about an actual deal that we funded, like a real life deal, and I'll cover that. How we figure out your loan is we're going to look at what's called loan to cost. So purchase price plus rehab. That's LTC, all right? That's going to see what are you going to pay for the purchase price and how much do you need to fix it up? What is the down payment? Typically, that's 10 to 20% of the loan to cost. The more experience you have, the less you put down. For example, I got a deal right now where the guy's putting 10% down just because he's done so many flips. When I say so many, I mean more than 5 flips, 5 or more in the last 3 years, okay? So quick closings, again, they close fast, and what's great is you can close in an LLC. That adds that layer of protection. So let's look at an actual deal that we funded. Now, granted, this guy did not have the best credit score, so keep that in mind. Now, he wanted to buy a $250,000 house. So purchase price is $250,000. Initial loan amount was $200,000 because he's putting 20% down in this case of the purchase price. Now, hard money loans fund 100% of the rehab. Okay, so I'll say that again: 100% of the rehab will be funded. All right, you just have to put down the down payment of either purchase price or loan to cost. In general, it's usually loan to cost. So in this case, he had a renovation budget of $100K. Total loan amount was $300,000, right? We took the initial loan amount plus the rehab loan amount. His after repair value is $450,000. This number is very important because he's telling us, hey guys, we ran some comps, my realtor and I, and we saw that the house is going to be worth $450,000 after we rehab it, okay? So what lenders do is they take the loan amount, they divide it by the ARV, and that gives us the 66% number that you see there, and you want that number to be under 70%. That will tell lenders that it is a good deal, okay? So you want the loan amount not to be too high, and you want the ARV to be as high as possible, right? But realistic. You don't want something that doesn't actually happen. So the loan terms for this deal are 12%, 12-month term, and its interest-only payment is $2,000 a month. So that's how much your payment's actually going to be when you start and you close on the loan on the house. So in this case, remember, he's putting 20% down. You have all the origination fee, the doc fees, all the other closing costs listed there. His initial cash to close was $63,575. There are costs per draws after you fund construction. You have to pay per draw. Like when you're ready on every project, you're going to go to the lender and you say, hey, okay, we finished a percentage of the project. We are ready for our next funds. So how that works is, let's say you start with $100,000 construction balance, right? And your first draw amount's 20, second is 20, third is 20, next is 15, right? So on and so forth. Your loan amount's going to go up and your monthly payment's going to go up because you're drawing on that money. So you don't pay interest on the entire loan amount. You only pay interest on the active loan balance. That's very important. And of course, you want to keep your draws, at least you don't want to draw too much because you're going to have to pay every time. And sometimes, it takes about 24 to 48 hours. So keep that in mind. And generally, hard money lenders want to see you start the work first. So you're going to have to actually have some working capital to begin construction because you can't really ask for it till after some of the work has been complete. Now, a lot of guys ask me, but Ben, do I need to finish all of the projects to get the money? No, you do not. So you don't have to finish all of plumbing or all of electrical or all of drywall in order to receive the money. In this case, for example, the first disbursement of 20%, right? When I say 20% of the total loan amount, first disbursement, he just had percentages, right? So, hey, I did 3% of clearing the lot, right? 10% of pouring the slab. So when you are requesting funds, you just tell us how much percentage of the work was done. We verify via inspector that that was completed, and then you get the money. Very simple. Okay. So if you need financing options, by the way, before I move on, we have several hard money investors to choose from. I have access to over 4,000 loan programs. So we have a lot of creative financing options. You can just book a call or just send my team and I an email, and we'll respond quickly if you need help, whether it's flipping, buying and hold, doesn't matter. Okay. So the pros of hard money loans are quick approvals, easy paperwork. You can close in your LLC. You only pay interest on the money that you use, and they're really good for quick flips. If you don't want to spend all your cash, right, and you never want to run out of capital, this is what guys do. They use hard money loans for many of their deals because that allows them to always have capital because you're not spending all of your money on your flip, right? You can, but a lot of guys don't because they want to leverage the loan programs that are available to them. Now, the cons, and this is something that a lot of guys miss, is that they have higher interest rates, right? Because they're going to move quick and they know that you're going to pay off the loan fast. There's no prepayment penalties, all right? And the loan terms are shorter, so you have to make sure you're in and out as quickly as possible. Granted, you have 1 to 2 years, but still, the less interest you pay, the better, right? And then there's a big final payment risk. Because it's a balloon payment, the lender's going to come knocking on your door after a year or two and say, okay, hey, pay up, you owe us if you haven't finished construction or if you haven't refinanced by then. So here's what lenders look for. Remember, but when you are trying to get financing for these deals, so we're going to say, okay, what's the ARV? What is your repair budget? Must be realistic. How much experience do you have doing other flips? Now, first-time investors are allowed, okay? But just note that they will look at your experience. That basically tells them the terms of the loan. And then they want you to have skin in the game. So there's no such thing as like 100% hard money, right? You have to have some money down. That's just, if you want to partner up on a deal, that's fine. If you have other guys that are going to chip in their down payment, that's fine. But there is no such thing as a lender coming in and giving you 100% of the rehab and 100% of the purchase price, and then you don't have to put a dime down. I don't care how great the deal is, right? They want you to have some money down, okay? So what you'll need to get started, I'm not going to cover this in detail, so here's all the documents. You can pause it if you want to just take a quick look or reach out to my team and I, and we can give you this checklist. But it's very simple: personal info, property details, business info, and then the scope of work. That's what we need to get things moving quickly. So the biggest mistake that investors make, and then we'll finish here, is that they don't have an exit plan. I'm telling you guys right now, the amount of investors that I see that don't do the initial upfront work, right? So that means two things. That means you make money on the purchase price, basically. So if you get a good deal and the rehab costs are low, but the return is high, that's where you win. But then the second part is guys don't have exit plans, right? So you want to have that plan in case you cannot sell. You can always do a DSCR refinance, but they require the property to at least be done. So keep that in mind. You want to watch out for those balloon payments that are going to come due, and hard money means quick and out. So remember, have an exit plan. Have a plan A, plan B, plan C if you cannot sell, because sometimes that does happen, right? And then the other part to it is if you don't do enough research on the front end of, hey, is this a good deal, right? Am I getting a good purchase price? Which is, there's a formula I can give you. You can just reach out and we can give you a quick formula to know if you're really going to make money on the deal. But you want to have a good understanding of the purchase price and the comps if it makes sense, pre and post closing. And then your crew and construction, that has to work. You can lose so much money with the contractors if you don't have a good crew that moves quickly and ones that don't overcharge you. All right. So my final thoughts are, it's a great tool when it's used correctly. It's risky if the project gets stuck. So that's why you got to be on these guys to move them. And I grew up doing construction. I see these guys take smoke breaks literally every hour. So I know how they work when the GC is not there, when the boss is not there. So you want to have that presence if you can there. That guy, I love, if I can have GCs there all the time, that's great because I know that the guys will be moving. And remember, have an exit plan. So if you need help, let's talk. Calendar link is in the description, and that's my email address. I hope this was genuinely valuable. Share it with an investor friend. Reach out, comment below if you thought this was actually helpful. Thank you.